We are following some breaking news, everybody, as well, with the Biden administration expected to announce today that the U.S. will, in fact, provide Ukraine with cluster munitions. That's according to administration and defense officials as well. These weapons, right, they disperse small bombs over a wide area that risk harming civilian populations. More than 100 countries have signed a UN convention.
Today, I think many people are surprised by the decision made by the Biden administration to support the use of cluster bombs to war against Russia. And I think it will be more destructive than solving the issue here. Here's the reason why. Well, using this controversial way to war against Russia will escalate further tension for Russia because it does not limit any potential of using nuclear weapons to fight back that can potentially lead to the World War III.
Miles back, observers from all services and several allied nations stand by for the first daylight tower shot.
The terrible swift power of nuclear weapons has to be seen to be believed.
The Convention of Cluster Bombs has signed an international treaty prohibiting the use of munitions, clustered munitions. Even their allies like France, Germany, UK, they have opposed the idea of using these cluster bombs. This device disperses many submunitions over a wide area that indiscriminately destroy cities and civilians. And not all the dots explode, which cause the region poses a threat to civilians to stay even after the war ends. So the extension of this war affects the global supply chain, inflations, and the stock markets. Now, in the stock market, we are also facing a clustered bomb. And of course, it's not a physical bomb here. It's a debt that United States has that potentially cause a major debt crisis. President Putin has warned that United States' US banking system is failing and may result in crises like US financial crisis back in 2008. Well, I would say that I'm not sure if it is because Putin has personal interest like shorting the market or he does not like US. But just look at some of these crucial data. I would say that there are three important factors that you want to consider here. First, high debt level in the United States. First, take a look at US debt levels here. The US national debt is currently over $30 trillion, and the debt of the US households and businesses is also very high. Furthermore, the US federal government budget deficits widened sharply in the first 9 months of the fiscal year to hit $1.39 trillion in June. The United States is currently running a large budget deficit because of the COVID-19 pandemic, and the government has spent trillions of dollars on stimulus programs and other measures to help economy recover from the pandemic. These spending programs have led to a sharp increase in the national debt. This debt could become, well, I would say a problem if interest rates keep rising, making it more difficult for borrowers to repay back their loans. Second, I would say the rise in potential defaults on mortgages and other loans. The report shows that an increase in total household debt in the first quarter of 2023, increasing by $148 billion to $17.05 trillion. Balances now stands about $2.9 trillion higher than at the end of 2019, just before the pandemic recessions. The report is based on the data from the New York Fed's, which nationally representative consumer credit panel. In the first quarter of 2023, mortgage balances experienced a modest increase of $121 billion, reaching $12.04 trillion by the end of March. On the other hand, credit card balances remain stable at 986 billion during the same period. Auto loan balances, it deviated from the usual trend of declining in the first quarters and instead saw an increase of $10 billion. Student loan balances also saw a slight increase, totaling $1.6 trillion. Other balances, including retail cards and various consumer loans, grew by $5 billion, and overall non-housing balances grew by $24 billion. Well, according to the executive of the biggest US bank, consumers are starting to fall behind on their credit card and loan payments as the economy softens. Well, despite that, I would say still this delinquency rate is still at the modest level now. According to the Wells Fargo chief financial officers, that today we have seen some consumer financial health trends gradually weakening from a year ago. Well, there are many potential factors behind this issue, that the worsening delinquency rates. Although the relative impact on each of the financial distress of household is somewhat uncertain, but I would say that influential factors could be the upward trend of interest rates. As interest rate climbs, borrowing costs increased, leading to the elevated minimum monthly payments for credit card balances. In contrast, most auto loans are fixed-rate loans, meaning that only recently acquired auto loans are affected by these higher rates. So this difference between the credit card debt, which is subject to the variable rates, and auto loans, which is subject to the fixed rates, is consistent with the pattern of the credit card delinquencies rising faster than the auto loan delinquencies. So this suggests that higher interest rates may be the driving force behind the increased delinquency rates. Now, the third factor is credit tightening. The recent collapse of Silicon Valley Bank, SVB, has prompted tightening credit conditions. So following the SVB failure, other banks have grown more cautious in lending practices as they are wary of the potential loss. Consequently, interest rates have also risen and lending standards have become more stringent for both businesses and consumers. This shift reflects the concerns surrounding the risk of additional financial setbacks, resulting in a more conservative approach to lending across the board. A recent Federal Reserve Bank of Dallas survey found that banks in its district have tightened lending standards for consumer loans, mortgages, and commercial real estate loans. The survey also found that banks are becoming more selective about the borrowers who they can lend to, and they also require a higher credit scores, and also they require a down payments. The credit tightening might lead to, what we call a credit crunch that is likely, I would say, giving a negative impact to the economy, as it will make it more difficult for businesses to obtain loans and expand. And this could lead to slower economic growth and job losses. So what trade opportunities might traders wish to monitor to take advantage of that cluster bomb phenomenon? Well, I would say that while higher interest rates have led to the failure of the mid-sized banks such as Silicon Valley Bank, Signature Banks, and First Republic Bank, apparently it has benefited mega banks. Mega banks have attracted customers seeking more secure and reliable options amidst the shifting interest rate landscape, and enabling them to provide a sense of safety and stability to customers during this period of change. In the last quarter, JP Morgan, Wells Fargo, and Citibank generated a combined net interest income of $49 billion, marking a 31% increase compared to the previous year. This growth was primarily driven by the expansion of their loan portfolios and the implementation of higher interest rates on those loans. So these three banks collectively witnessed an increase in their loan book compared to the previous year, partially due to a rise in credit card balances contributing to their overall revenue. So as a result, these banks have raised the projections for their lending profits in 2023, indicating that their expectation of a relatively stable borrowing and deposits environment without significant shift. If the US economy goes to soft landing with continuous interest rate hike, I would say that investors might overweight more towards mega bank stocks. But there are also challenges for the big banks to keep the trend. Well, I would say that all banks are trying to pay more to depositors to keep them from moving their money away into a higher yielding money market funds after years of paying next to nothing on consumer checking accounts. So in conclusions, the trends are indeed still alarming, but today we are looking at S&P 500 at around 4,500 level. It was at a level somewhere in October 2021, just before the market correction in 2022. The Shiller P/E ratio of the S&P 500, or price earning ratio that is based on average inflation adjusted earnings from the previous 10 years, which is also known as the CAPE ratio, cyclical adjusted P/E ratio, is 30.9, which is, well, I would say about 53% above the market average of 20.2, which suggests that the market today is kind of overvalued. I would say that there is no way we can predict how the stock market will move in the short term, and we have to continue watching it. Well, despite inflation seeming to cool off, the market predicts that the Fed is still increasing the interest rates to combat inflation down to 2% level. And many expect that this recession will come in half of 2023 or early 2024. And that is because the fall of inflation and slow economic growth contributes to margin compressions. So while some investors have even labeled early 2023 as the start of a bull market, others are not really convinced, and I would say that they warn that the recent rise could be a bear market rally.